Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are going to be continuing with our PM revision series. So this is chapter number 8 which we have come to. It's been a long journey. We have so far revised 7 chapters in total. This is going to be the 8th video where we are revising chapter number 8 which pertains to relevant costing. So this is one of the syllabus areas where students tend to struggle in the numerical portion because it's either the concepts that they do not understand or they do not remember the concepts. So let's try to fix both of these problems to understand the concepts so that we are able to solve the numericals well. Now, when it comes to relevant costing, there are, scenarios where we talk about relevant costing for material, where we can talk about, let's suppose, labor, where we can also, let's suppose, talk about, some non-current assets which we are, planning to take, or the topics which are there in this chapter also include make or buy decisions, whether we should shut down the department that we have, will it be more profitable, and also talking about briefly joint products. So let's first begin with the relevant costing when it comes to materials. Relevant cost for materials. So whenever you are evaluating whether a cost is relevant or not when it pertains to material cost, so there are two possibilities. Either the material which you require is in stock or it is out of stock. So these are the two possibilities. So if it's something which you're regularly using in the business, probably you'll have it in stock. There's also a possibility that it is out of stock because you have used, the material which is used in your production. So there are two possibilities. First is in stock and second is out of stock. So when it comes to out of stock, that means the relevant cost, if we are taking that, what will be the relevant cost over here, it will be nothing but the current price at which you can purchase. So the current purchase price. Then if I talk about materials which are in stock, again there are two scenarios. So perhaps we have a regular use for this material. The second scenario is that so if it's in regular use and we use it for this contract, then it will be replaced. But if we have this material in stock and this is not something which we use regularly, then it will not be replaced. So these are the two scenarios which can occur if the material we have in stock. So if it is something which is in regular use, then it will have to be replaced because we use it for the business needs also. Then the relevant cost is going to be again the current purchase price, the cost at which you can replace the raw material for your own production, even if you take this contract or not. Then if we talk about a scenario where it will not be replaced, this is not your regular use, then the relevant cost over here is going to be your opportunity cost. Now what do we mean by opportunity cost? That means it's going to be the cost, the cost is going to be the lost scrap value. So perhaps, I had this material, let's suppose worth $800, which I do not use. It was probably bought by mistake, and this is not something which I will be using. Now, there is a contract which requires this material, which is worth $800. And let's suppose if I do not use this in the contract, I will be able to sell it off at a scrap value of, let's suppose, $400. And if I use this in the contract, maybe I'll get some revenue. So over here, the cost which will be relevant for you will not be 800 because this is already a sunk cost. Sunk costs will never be relevant. And then 400 is basically the contribution or the scrap value which you are losing because of using this material, because you will not be selling it off, otherwise you would have sold it off for $400. So over here, the relevant cost for this specific material will become the scrap value of $400. Again, like I told you, if there is an alternative use, So alternative, if I say there is no alternative use, that means it's going to be of no use to me. Then in such a scenario, it's going to be the scrap value. But if I can use it at some other thing, maybe the material which I have directly cannot be used, but can be further processed or sold off. So in this case, I will be taking the higher value of either using it or selling it off. So these are the two options which you have in such a scenario where the material which you are requiring is in stock and will not be replaced. So let's also discuss a few pointers before we move on to the relevant cost of labor. If you have any historic cost for the materials, they are always going to be a sunk cost and will never be relevant unless it happens to be your current purchase price. So let's suppose I bought a material at $800. I have already spent that money, so it becomes a sunk cost. This is not relevant. But if the purchase price today also is 800, then this becomes a relevant cost because this is the current purchase price. So this basically is a note which I wanted to share with you. Another thing is that if a material is something which you have in short supply, that means it's very difficult to get that material. In such a scenario, the proposal can be undertaken, would be denying other part of the organization that resource. So over there, let's suppose you have this material, let's suppose 100 kgs, and this 100 kgs, if you use in the contract which you are evaluating, then you will be, not having enough material for your internal use, which you otherwise would be, requiring even if you do not take this contract. So if this is something which you're taking away from your own organization to fulfill this contract, then your relevant cost will be the normal cost of the material. Let's suppose this is 100 kgs at $5 per kg. So $500 plus you're also going to take as the relevant cost what is the lost contribution to the organization. So let's suppose from these 100 kgs, I was able to, generate a contribution of, let's suppose, $100. So my relevant cost is not going to be just 500, but addition of 100, which will make the relevant cost as $600. So these are a few notes I wanted to discuss. Now we move on to the relevant cost of labor. Relevant cost of labor. So when it comes to evaluating whether, what cost should you be taking as relevant cost for labor, again, there are two scenarios. So the two broad scenarios is, first of all, if the labor has spare capacity. So maybe you're paying your labor for, let's suppose, 10 hours a day, and 2 hours they sit idle. Only 8 hours of work is allotted to them. So then that means they have the spare capacity. Then another scenario can be if they have full, the capacity is full, you will have to hire more labor. So in such a scenario, if when it comes to spare capacity, your relevant cost is going to be zero because you're anyway paying the labor. It's not nothing extra which you're going to pay the labor because of this contract. So that is why you're going to have the relevant cost as $0. Now when it comes to full capacity, again there are two possibilities. Either you can hire more labor, or another possibility says you cannot hire more labor. So let's discuss, what's going to happen in each of these scenarios. So maybe when I have to hire more labor, definitely my relevant cost is going to be nothing but the amount of money which I pay to them. So my relevant cost becomes the extra that I pay to the labor. So extra cost of labor will be my relevant cost at this point. Now, if I talk about a scenario where my labor is already at a full capacity, they do not have any free time with them, and I cannot even hire more labor. So my relevant cost over here will probably be the opportunity cost. That means, the capacity is already full and I cannot even get more people out. So the best thing that I can do in such a scenario is divert my existing labor to this new contract. So if I do that, the amount of payment, or the amount of relevant cost that's going to arise over here is the opportunity cost. That means the lost contribution and if at all I'm paying anything extra to the labor, so extra cost of labor. So these the sum of these two is going to give you the relevant cost in such a scenario. Now, to understand that what exactly we mean by relevant cost. So relevant cost, ideally, I think I should have covered this at the very beginning of the session. So relevant cost is essentially, all of your future cash flows which are arising. So these are future cash flows, and writing the prominent characteristics. So they'll always be future cash flows which are arising as a result of a direct consequence of a decision. So direct consequence. So probably I've taken a decision to, let's suppose, travel to some other place in my city. So the decision is going to cost me, let's suppose, 50 rupees in the metro. So this is the cost which I am paying as a direct consequence of the decision that I've taken to go out to the other part of the city. So this is a future cash flow. This is something that I'm going to incur when I go to the metro station, and the direct consequence in the sense that I'm only paying this money because I decided to go. So these are the two main characteristics when it comes to relevant costs. There is also a possibility for us to classify some of the common costs into relevant and irrelevant. So when it comes to incremental costs, they will always be relevant. Incremental basically means anything which is additional, anything which is extra because of the decision. So anything incremental, cost or revenue, both will be relevant. And another thing which will always be relevant is the opportunity cost, which is the cost of the next best alternative that you have foregone. When it comes to irrelevant costs, sunk costs will always be the costs which will be irrelevant. Even the committed cost basically means which you have already told, even though it's going to be in the future, but you have already told that person that no matter what happens, I am going to pay you this much of money. So this becomes a committed cost, and because this cannot be avoided, this is sure going to happen in the future. So that is why this is something irrelevant, because even if you undertake the project or don't, this is something that you have committed to, you are still going to pay that. And sunk costs, like I've already explained, sunk costs are the costs which have already happened in the past. This is the money which we have already paid out. So this is a sunk cost. And another thing which will be irrelevant is going to be your non-cash flow cost. Anything which does not involve you actually paying out money, that will not be relevant. So this is a broad classification of the relevant and irrelevant costs. Now let's also try to see what are the relevant costs when it comes to non-current assets. So when it comes to non-current assets, typically what the relevant cash flows will be, first of all, so I'm talking about the relevant cash flows first. So the things that are going to be relevant, first of all, it's going to be the purchase price, right? So this is the amount of money that you need to pay out to buy the asset. Then another thing which will be relevant is the scrap value or the disposal proceeds. Another thing which is going to be relevant is that, if you are using an existing machine in a project which would otherwise be sold if you did not take that project, then that becomes the opportunity cost, the proceeds which you forego. So probably I have this machine in my business, I was planning to sell it off, but now I have gotten this contract which I am evaluating. So this contract requires me to use this machine. I would have sold this machine for, let's suppose, $10,000, but now that I'm taking this contract, I will not sell it off. So the opportunity cost, which is the scrap value of this machine, will also have to be foregone. Now, another thing which will be relevant over here is that if we need to take an existing machine from another department and it is not replaced, either by choice or because of the replacement not being available, then also there will be an opportunity cost because of the lost contribution. So if you are shifting the machine from one department to another, so the department which has lost the machine from where you have taken the machine, if it is causing any lost contribution, then that also becomes a relevant cost. Now let's talk about the irrelevant items. So if I talk about the irrelevant items, first of all, it's going to be a depreciation because, as I have mentioned in the list above, that depreciation is a non-cash flow cost. That is why it is something which is not relevant. Then another thing which will be irrelevant will be the profit or loss on disposal. Profit, loss on disposal. And why is that not relevant? That is because this profit or loss on disposal is actually the figure which you arrive using the accumulated depreciation. Now because the depreciation itself is not a relevant cash flow, this is something which also becomes irrelevant. Another thing which becomes irrelevant is the original purchase price of any machinery which you have in existence at the moment. So any existing machinery's purchase price, existing machinery purchase price, and that's also because it's a sunk cost. This is the cost that you have already paid. So this will not be relevant. Another thing which is an irrelevant item will be the carrying value of the existing machinery. So carrying value of the existing machinery. So this is also going to be irrelevant. Why? Because again, this is a combination of your original price. So this will basically be the purchase price minus the depreciation. Both of these are irrelevant. So this entire thing as a whole becomes irrelevant. Now, let's with this we are done with the relevant and irrelevant costs of different items, labor, material, and non-current assets. Now let's talk a little bit about make or buy decisions. When it comes to make or buy decisions, the relevant, so again over here, there can be two scenarios. The first scenario being that you have no limiting factor, everything which you need, every resources that you need in whatever quantity, you have that. So in such a scenario, the relevant costs will just be the differential cost between the two items. Differential costs between the two options. So maybe I can buy something from outside for $10 and internally I make it for $8. So the relevant cost is only going to be $2. This is in a scenario where there are no limiting factors. Now, when there are limiting factors, in a scenario where we have limiting factors, where the resources which we need are scarce, we have to use some steps. So what are going to be the steps? First of all, we have to calculate the variable cost to make per unit and to buy per unit. So first of all, we calculate the saving. So saving will be the difference between the variable cost per unit and the buying price which I'm getting from the market. How much I can get it from the market is the buying price. So this, the difference between these two is going to give me the saving. Then what I'm going to do this, I'm going to divide this by the amount of the scarce resource. So let's suppose machine A, time on machine A is my scarce resource. So I'm going to divide the saving per unit of the machine time. Machine time. So this is going to give me the savings per unit of the limiting factor. Now I'm going to rank the products, create a ranking that where the saving is the most, and then the fourth step will be to allocate the scarce resources allocated according to priorities where we are getting the most saving. And the last step over here will be that any products which are left with unsatisfied demand can be satisfied from buying. So scarce resources will be allocated, anything which gets left out you will buy from outside. Now let's also consider what are the non-financial factors that a company can consider when deciding to make or buy. So there can be a theoretical requirement which asks you to consider other factors rather than the financial ones. So other factors. So first of all, if a business is thinking whether it should make its own thing or buy it from outside, first of all, they should consider how reliable is the external supplier. So reliability of external supplier is going to be something which, is something which the company should consider. Then another thing which they should consider is if it requires any specialist skills. So perhaps if the product that you're making requires special skills, so you may not probably prefer to buy it from outside and make something of your own. Then another thing which they should consider is the alternative use of resource. Another factor to consider are the social factors. How's the society going to react if, whether you make it or buy it? Another thing to consider is the legal factors. Will the business be in trouble for buying something from outside? Confidentiality, again, a very important thing. So I can illustrate this also with the help of an example. So if I talk about McDonald's is the American chain which operates in multiple countries. So talking about India, it sources the raw materials that it uses. So probably the potatoes and all the vegetables that it requires for the products that it sells. It has contracted with some farmers to get these products. So confidentiality over here is important because these farmers or the people who are supplying these raw materials are supposed to not reveal that they are in a contract with McDonald's, so that the confidentiality remains intact. Another thing is the customer reaction. How are the customers itself going to react? So probably if I am sourcing some important raw material from outside, and if anything goes wrong, then the customers can also react, and that will lead to an impact on my business. Then let's talk about shutdown decisions, which is the next concept in this chapter. Shutdown decisions basically are about, so there might be multiple divisions in the business. So there some may be making profits, some may be making losses. So to decide whether or not the loss making business should go on or should it be shut down. So whenever we are evaluating such a thing, first of all you should be looking at the quantifiable aspects. So the quantifiable costs and benefits. First of all, you're going to lose the contribution. Whatever you are earning, let's suppose I'm talking about department B, whatever contribution this department is earning, that's going to get lost. Any saving which we get in specific fixed costs, so probably this there are a total fixed cost of $100,000, but 20,000 out of this is because of this department. So if we close department B, we also save $20,000. Another thing which will be quantifiable will be any known reorganization costs. Known reorganization costs. So basically, if I'm closing, I initially had three departments, and if I'm closing one department as a whole, there might be some reorganization which I have to do to the other departments. So if there are any known costs with regard to this, that will also be considered. And any known contribution from whatever, so perhaps let me explain this with an example. Any known additional contribution from alternative. So let's suppose in this same scenario, I'm thinking to shut down department B and creating a new department D. So any known contribution that I'm going to get, so probably out of this department alone, I'm going to get $100,000 in contribution. So this will become a relevant thing for me to consider when I'm making my decision. Now let's talk about the non-quantifiable things, non-quantifiable costs or benefits. So first of all, which cannot be quantified is how the customers and suppliers are going to react. So the reactions of customers and suppliers. This is something which we do not know. How are they going to respond? Another thing to consider is going to be the knock-on impact of the decision. What do I mean by knock-on impact? Knock-on impact basically means how is it going to affect the sales of other products. So probably there were some people who bought products from department B and C together. Now that I shut this department, they may not even come back to buy products from department C, and I will lose the revenue from this. Another thing, to consider is the loss of goodwill or reputation. So because you're shutting down some part of your business, people may conceive that you're making losses, and it may lead to loss in your goodwill. So this is about the shutdown decisions. Now let's come to the very last topic under this chapter, which talks about joint product costing. So let's first understand what joint products are. So joint products basically are, where the manufacture of one product inevitably results in the manufacture of other products. So probably you are taking a process, and due to this process, the goal was to make A, but because you are running this process with A, B also gets made. So this is what is called joint products. So, another thing which you need to know about the terminology is the split off point. So, basically, in the process where you are able to identify, which product is which, so probably this is my entire output, and after this process, another process that we do over here, we are able to identify that this is product A and this is product B. So, this point where we are able to identify is going to be called the split off point. Another thing to know is that the costs which are incurred before the split off, these will be called the joint costs, because over here you do not know exactly which product is causing which cost. Now, another thing to note over here is that when you are deciding whether or not you want to process something further, so further processing, then you consider only the future incremental costs, future incremental cash flows. So what do we mean by that? First of all, any difference in your revenue and extra cost. So all of this should be considered whether to decide whether or not we should process the things further. And joint costs, whatever are the costs that were incurred before the A and B were identifiable, then joint costs are considered to be sunk, because the process has already happened, we have already undertaken this process, so whatever the joint costs are already sunk, so that is why they become irrelevant in making the decision. With this, we have come to an end to chapter number 8, and in the next video we are going to be meeting and revising the chapter number 9. I hope that these videos are helpful to you. Thank you so much for watching.